Hello traders, it's Nikos here. In this video I want to demonstrate how to trade a late and how to manage and trade a late entry. In this case I have the GBP Australian dollar here, and it's a 5-minute chart. I have a 4 pip spread. Price is trying to move a little bit lower. That means we have an entry right now. I take the trade here. And the reason I take this example is because this really is a late entry. What does that mean? It means that the price already moved in one direction, in this case short, for a longer time, and the chance for bigger retracement is always there. That means the chance that the price won't move lower but actually just create a higher low and then move against us. So then we have the problem that most traders say, okay, if that's late and it's dangerous, should I still take the trade? You should, in my opinion, if it makes sense and if the price is volatile. It means if you see movement on the chart, and of course if you are into day trading or scalping. If we do the top-down approach on this pair, you will see that the price just hit the 36 EMA on the daily chart here. It means major support. It's also trying to break the 36 if I zoom in a little bit, but it's easy to spot. You also have topping formations up here. This is a double top or triple top at a number that's the 1.74 number, so a round number also, and the price is moving up for almost, I don't know, many months now, since March. Okay, so it's about, it moved up 3,000 points. Created this double tops, as you can see again on the daily chart, and now it looks like it wants to move lower. We still have support here, so if you connect the lines from here to here, you will get a nice powerful trend line, support line, and that means that the price could react and retrace back. Okay, that's why it's also a dangerous spot to trade. On the 4-hourly chart, the price created lower highs up here and now hit the 200 EMA for the first time. And if the price moves in one direction, we usually say, in this case, since it broke the 200 EMA, it moved up almost 300 points, created the lower high, and now hit the 200 EMA after another 270 pips. So yes, the chance that the price will bounce here is very big, and usually we avoid trading short setups, especially on higher time frames when the price hits major support. Right on the 1-hourly chart, you can see the price hit also and broke the 633. The 633 is also support, and we like bounce trades in these areas, but the price broke the 633 as well. Now all that support in this area coming from the 1-hourly, 4-hourly and daily means that we have to be careful. There's only one thing that actually is pointing our way, and that is price action. The price in all these time frames is still pointing down. Red candles on the daily, red candles on the 4-hourly chart, red candles on the 1-hourly chart. We don't ignore the fact that the price moved down since the previous retracement over the 36, already another 230 pips. Yeah, we don't ignore that, but price is the best indicator of all, and because it's moving down, we can still take the short trades if a signal appears. We just need to manage them, these trades, really quickly, and we don't want to risk much. That means the 36 here, our resistance, also our guide on this trend. And if you measure your distance after drawing, give me a second, I have to set it up here. After drawing your lines, you'll see since up here, that's the resistance line. Now the 36 EMA is your guide, the angle is changing a little bit. So after our entry here, we have to put a stop, right? And the stop would be about 20 pips over 0.3 plus the spread. So that's about 20 pips. That means we cannot take profits until the price reaches the 20 pips target, right? So if we have a small account, and that is another matter I want to discuss, if we have a really small account, then we can sometimes only trade micro lots. And if you have an account of this here started at I think $200 something, it's also a good example for traders who do not have big trading accounts. Okay, so what you have to do is actually make sure you trade really small positions. Ideally want to split a position into 3 parts, and if the stop is too big, in this case a 20 pip stop, okay, with 3 micro lots would be more or less $6-7. That's it. Now $7 of 100 out of 100 would be 7%. Okay, now out of 350-60, it's much less, so we're talking about less than 2% here. So you could have actually done that and just split this position into 3 parts. Now the reason I just took 1 micro lot is because I wanted to demonstrate a quick entry, a quick late entry close to support. And many traders just take 1 tiny lot if the price is close to support on the higher time frame. So 2 ways you can manage this trade, because you cannot split this tiny lot into 3 parts anymore, or you can't even take out half of the position here in case you want to split it. You have to decide what you want to do. You can take out your 20 pips if the price is reaching your target, or you just leave the stop over your 0.3 in this area, and in case you have only 1 lot, of course, then you take out your 20-25 pips and it's over. You forget about your trade. Simple as that. That's all. There's not much you can do about it. Now I logged in a little bit late here for this follow-up video, but you see, in case you would have used 3 lots and risked less than 2%, like 1% of your account, you could have made easily your 20-25, your 40 or 50, 2 times the stop, and then you create your win-win situation. It means you have your stop here, you made already 20 and 40 pips on average. In case the price decides to break resistance and hit your stop, then okay, you just keep your 40-50 pips with a second position, with a second lot, and make still some nice profits. Yeah, you can leave this stop there and then manage your trade on the higher time frames, or you can just say, okay, it's volatile now, I'll start trailing my stop now over the 36, in this case now close to break even, probably a few pips profits, and in case the price retraces and hit my stop, I keep my 20 or 25 and 50 pips, and that's it. So with a small account, that's why I use this practice account. It's not that easy to trade because you have to split tiny positions. So I would advise, if you trade micro lots, Never risk more than 1 or 2% if it's a swing trade, and you can still make profits. It just need more time. And I would not open a smaller account than at least $300 to $500 or euros. Okay, I can show you here. That's, as I said, a practice account I use with some of my students often. If we go to where is that? Here we go to our account history. We still have a swing trade running on GBP US dollar here, and if we go to the account history and scroll down, you will see there are not many trades taken, only a few trades, only micro lots all the time, and over the time, I think the last 3-4 months we made only $100. That means we started with 200 something, right, and now it's 365. Of course it takes a while if you want to grow a tiny account like this one, but if you don't have more money to trade, it's just also a good exercise, getting good at what you do, practicing discipline, having fun with it, and slowly grow your micro lot account. And if you reach I don't know, $1,000, you can start trading bigger lots, going to mini lots, and this is also a very good way to grow your account. But you have to stick to the rules, have to be disciplined, and enjoy what you do. Okay, I hope this video was helpful. I'll catch up with you later on in the live room. Bye for now.